Certainly. First of all, I mean, that's the straight and transparent answer for that. I mean, it is something that we obviously monitor ourselves without even the kind of a regulatory requirement for that, because I mean, obviously for us, making sure that the quality on our books is as good as it has ever been. But to mitigate basically the problem, originally already when we have provided the loans to the customers, we do a stress test and stressing actually the ability to serve the loan with 6% interest rate. We did that already and during even the sort of a negative interest rates time. So at least the borrower knows when they get a loan that, okay, if the worst comes, that this is where it might end up to. Well, of course, that's the situation when we originate the loan, so anything can happen thereafter. But then it's our sort of a responsibility to follow up. And what we also do now and have done already ever since from last year, basically when the interest rates started rising, that we actually kind of pre-contact borrowers that we, from our data, see that there might be issues. So we have an ability basically to kind of mitigate some of the potential issues by contacting before there are problems. And the other thing that even though we have the floating rate there, most of the loans lately have been so-called annuity types, meaning that the monthly base or the monthly amount that the people are paying back the loans remains the same regardless of what the interest rate is. What does happen though is that then it starts to build up a float to the end of the period of the mortgage, which people then we have to of course tell people that, okay, please make sure that in 20 years time you have the kind of a remainance in case the interest rate has been high enough. But we have so far, I mean, what we have monitored in our credit portfolios, we're doing quite well. I mean, of course, we do have to do things and we have to monitor that carefully. But as so far, at least, we're fine.